In March of 2009, the market was in abysmal shape. How many of you are concerned or curious as to where the market's going to be in the next couple of years? That's what we're going to spend the next hour looking at. We're very fortunate to have with us Thomas Noonan. He's from Fort Lauderdale. He's president of Thomas Noonan Incorporated. He's been quoted in a number of financial periodicals, including Money Magazine, the Miami Herald, the Las Vegas Sun. He's a consultant for the Joint Labor and Management Committee for the retail food industry. And just talking with him in the last half hour gave me a pretty strong sense that he's going to give us a pretty good roadmap as to how we got where we are today over the last 2.5 years, and more importantly, what you can do as you look toward the future. I'd ask you to turn your cell phones on to vibrate, and I'd also ask you to join me in giving Tom a very warm welcome.
Thank you, Rick. Can everybody hear me in the back? Do I have this thing hitched up right? Okay. My best friend in high school was a guy we called Shug. And Shug was a smart guy. I grew up right outside of Buffalo, New York, and Shug, my best friend, was a pretty smart guy, and he graduated either valedictorian or salutatorian of our senior class. And he got a full scholarship to Cornell University. And I, on the other hand, being not so smart, I went on a fully paid basis to Florida Southern. And our freshman year in college, we came home for a Christmas break, and we were all excited to see each other again. And we were talking about our respective schools. And over that break, Shug confided in me that he was going to take the next semester off, try to earn some money, and then he was going to start back up in September. I didn't think much about that, but one day over that Christmas break, I was having dinner with my parents, and I just happened to mention, oh, by the way, Shug's going to take the next semester off and start back up in September. And with that, my father slammed his hand on the desk. He said, "No, don't let him do it. It's a huge mistake." He said he's on a full academic scholarship. He'll never go back. And I said, "Come on, Dad, it's only one semester." Well, as it turned out, my father was right. He never went back. He bounced around from job to job, and the last time I saw him before he died, he was down here in the middle part of the state of Florida. The reason I mention that is my father was a wise old man. And I like to, for whatever business you're in, I don't care what it is, the longer you're in it, the more you do certain things, the more you can sort of see when things don't pass the smell test. And it's the same in my business. And now I feel like I'm the old man because I've been in the business so long. Now, I'm not talking about people that can tell you which way the market's going to go or tell you, whether a stock's going to go up or down, but certain things just don't seem right. And I'll give you a couple of examples. Back in the late 90s, if you think back in the second term of President Clinton, everybody was making money. All your pension funds, everybody was making money. The biggest complaint you'd get from people was their fund wasn't making as much as the next one. But if you looked at it closely, the only thing that was really making money back then was growth. If you were in value and some small caps and stuff, wasn't doing anything like growth. The dot-coms ruled. And it was just an unbelievable time for the market. I've been in the business a long time. I just didn't like it. I didn't think it was right. And there was an article I was quoted in a publication, I can't remember which one, but it was around 1998. And what's the market going to do and what are people doing? And in this story, everybody was just as bullish as could be. I mean, they couldn't get enough Sun Microsystems and all the rest of these things. And I was like the last paragraph or two of the article, and I said, I think that this market is an accident waiting to happen. I said, there's stocks out there and companies that aren't making any money, and in some cases, they don't even have any revenue. Their stocks are going up 3 or 4 points a day. I said, it makes no sense. And people would call me up and tell me what an idiot I was and how much money they were making, and it was all different now, they said. It's different this time. It's because of the internet. It's all different. And I really have to admit that I started thinking, maybe the business has passed me by because I didn't participate at all in that. But we all know what happened. Along came Y2K, and most of those dot-coms either went down 90% or disappeared. And it proved that, you know, sometimes when you are the wise old man, you do understand it. Now you go to the 2003, 4, 5, 6, 7. What are people doing now? Everybody's flipping houses like they were flipping .com stocks a few years ago. I mean, I had fights with my kids. Their friends are out buying 3, 4, 5 condominiums. They want to do it too. They've got some money. I said, don't do it. This is the NASDAQ of 1999. It was so incredibly obvious to me what was going to happen. And we all know it did happen, but what really topped it off for me was I had offices on both coasts. And when I'm on the West Coast, I eat at the same breakfast place all the time, a $2.99 breakfast place. And I'm in there one day, and one of the waiters I know comes over to me and says, hey, Tom, I just bought a new house. And I said, hey, congratulations, Rico. Yeah, 3-bedroom, 2-bath, down in the valley. Said, got a big backyard. And I said, well, how much did you have to pay for it, Rico? And he said, well, I paid $400,000 for it, but I was able to get a $450,000 mortgage, so we got new furniture, and we got some backyard all fixed up with slides and things like that. I said, $450,000 mortgage, Rico? I said, what are your payments? He said, $780 a month. And I said, Rico, come on, you know me, money's my game. I said, $450,000 mortgages don't have $780 payments. Well, this one's different, and then he goes on and on. And okay. Now, I want to walk you through a couple of things, and you'll see how things really happened. Let's just say it's the 1970s, okay? Early to middle 1970s, and you wanted to buy a house. What did you do? You went out and got a realtor, you drove around, you looked at all the places, you finally found the house you liked, you struck a deal with a seller, you signed a contract. What's the next thing you did? The next thing you did is you went over to your local savings and loan to get a mortgage. And back then, they'd probably give you a mortgage for 7%. So you take the mortgage, you pay off the seller, you got a great deal, you own a house. Well, 3 or 4 years later, for those of you that were around then, interest rates went up very, very dramatically. Savings and loans were having to pay their depositors 17% interest to keep their money in the savings and loan. Otherwise, they'd move it somewhere else. But yet they were only earning 7% from you guys that took out the mortgage for them. Well, when you earn 7% and you pay out 17%, that's not a good business. And that single factor almost bankrupted the savings and loan industry going back 30 years ago. Well, now, fast forward, if you would, to 2010. Let's just say you want to buy a house today or whatever. What do? You do the same thing. You might find it on the internet, but you might get it through a realtor. But what do? You strike a deal with who's ever selling it, and what's the next thing you do? You go over, now you got choices. You go to the savings and loan, you go to the bank, you go to the mortgage company to get a mortgage. And what are they going to offer you today, right now, today? What are they going to offer you? They're going to offer you a fixed rate mortgage, 4 3/4% for 30 years. Now, why in the world would an industry that wiped itself out 30 years ago by doing this kind of stuff, why in the world would anybody lend you money at 4 3/4% fixed for 30 years today? And the answer is quite simple, as most of us have found out in the last few years. When you go in and you sign those papers at a mortgage company or a bank or wherever you do, the minute you sign the papers and walk out the door, they sell that mortgage to somebody else. They don't want the risk. Well, who have they been selling those mortgages to all these years? Wall Street. Wall Street took over the mortgage business in the early 2000s. Every single mortgage that was created, Wall Street would buy. And you say, why would they do that? They'll take Rico and they'll put 99 other people like him into a pool. They'll give it a funny name, and they'll tack a 3 or 4% commission on it, and they'll sell it. Well, who'd they sell it to? They sold it to everybody. Individuals, pension funds, banks, insurance companies, foreign governments. They sold them to everybody. And you say, well, why in the world would people want to buy pools of subprime securities? And the answer is because they got yields that were 200 to 300 basis points higher than you could get in comparable investments. 2 or 3% more you could get in these subprime securities. Wall Street was cranking these things out so fast, they were selling them so fast, that they started buying mortgage companies so that they could create their own mortgages. That's how fast this business was growing. Well, along around I'd say the 2005, 2006, the business started to slow down for whatever reason. And one of the reasons it did slow down was most subprime securities were not rated. If you compare a subprime security to other fixed income investments, They're rated, AAA, AA, single A, right on down through the Ds, okay? Subprime securities weren't rated. So Wall Street came up with an idea. Wall Street is always very innovative, in case you haven't ever noticed that. They came up with an idea, and I got to move you to another market just so you'll understand how it works. Let's say the city of Orlando, Florida, wants to build a new police station or a fire station or a school or whatever, and they need $50 million. Where do they get the money? They get the money by borrowing it by selling municipal bonds. Cities, counties, states, that's what they do. They borrow money by selling municipal bonds. All municipal bonds are rated, okay? Now, let's, for the argument's sake, I know nothing about Orlando, Florida, but for the sake of this argument, let's say Orlando, Florida has a single A rating, the one that wants to borrow this money and build the police station and the fire station. If you are a single A rated entity, you have to pay this much interest on your bonds when you borrow money, okay? But the city of Orlando, Florida has an option. They can go to an insurance company like MBIA or AMBAC and get their bonds insured, which will give them a AAA rating. Why would somebody want to insure Orlando, Florida? Because it's like stealing money. They know they're not going to default, so they keep getting premiums for doing nothing. This is a business that Warren Buffett is in. You know, you insure municipalities, and you have to pay them a premium every year, and they don't have to do anything. But why would Orlando, Florida want to do this? Because now they've got a AAA rating. So when they sell bonds, now they only have to pay this much interest when they borrow money, as opposed to paying this much if you're single A. So it works for both people. Okay, I got to move you back over to this market again now, the subprime securities. What did Wall Street do? Wall Street went out to these firms that were insuring these municipal bonds, except for Warren Buffett, who was too smart to do this, but MBIA and AMBAC, the other people that did it, they did it. They went over and they started insuring these subprime securities. So now they're AAA rated. So now all of a sudden the government of Mexico, which is prohibited from buying anything that's not AAA rated, now they can buy subprime securities. And the German banks, they can buy, everybody starts buying these things all over again. So the market opens up and the business just gets cranking again. But what had to happen? It was so incredibly obvious what was going to happen. It's just, how this thing got to this point is beyond me. What had to happen? Rico. What happened to Rico? Well, I'm sure he was writing that check out for $780 a month until they zapped it up to what it should have been, $4,000 or whatever it is. Boom, he's done. He doesn't make any more payments. And there's a million other Ricos out there in all these things, okay? Now just imagine, you're the German bank that put $50 million into this AAA rated security, and all of a sudden your payments are going down. Well, what's going on? My payments are going down. So let's check. What is this thing selling for? Well, we put $50 million in. After 3 months, still $50 million. 6 months, yep, $50 million. Year later, still $50 million. Subprime securities were never marked to the market. Marked to the market means you get a statement from your brokerage firm. Last month you had your stocks are worth this much in bonds. Now every month they change it, right? It goes up and down. Subprime securities were never marked to the market. Everybody just carried them along what their original face value was. The pool's full of Ricos that are all being carried along as full face value. Well, when this hit everybody, not just the German bank, but everybody else, started questioning what's going on, then the feds got involved, okay? The feds were completely out of this game. There were so many people that were derelict in this stuff, and the feds were just as guilty as everybody else, okay? The feds now get involved, and they start making, all these firms start marking these things to the market. Well, when they started marking them to the market, of which they were really trading for all over the place, what happens now? All of a sudden, this is now you're going into the third quarter of 2008, all of a sudden some of the big players are in trouble, starting with Lehman Brothers. Lehman Brothers was an old line investment banking firm, and they've been around a long time, one of the premier names in the business. When everything had to be marked to the market, as it did in the third quarter of 2008, Lehman Brothers was $16 billion in the hole. They had basically a margin call for $16 billion, okay? So then Secretary Treasurer was, what's his name? I can't even think of it. The big tall, Paulson. Secretary Treasurer Paulson and Bernanke and Geithner was head of the New York Fed. They call everybody to New York for a special meeting. This is on Friday night. Okay, they bring in all the players, Goldman Sachs, JP Morgan, Morgan Stanley, Merrill Lynch, Deutsche Bank, all of them, brings them all to New York. All right, we got a major league problem here, boys. Lehman Brothers is $16 billion in the hole, and they've got to be bailed out before Monday morning, or by law, they have to declare bankruptcy. So it looked like over this weekend that either Bank of America or Barclays of London was going to take over Lehman Brothers. That's what it looked like. Well, over the weekend, Bank of America fell in love with Merrill Lynch, and they agreed right there at this meeting in New York that they were going to take over Merrill Lynch. So Bank of America is not in play anymore. So it leaves Barclays. That's the only one left. By Sunday night, they were popping champagne because it said Barclays is going to take over Lehman. We're going to dodge another bullet here. But at the last minute, the attorneys for Barclays came in and said they cannot buy Lehman Brothers without shareholder voting approval, which they can't get until at least Tuesday. Under federal law, they didn't have until the market opened on Monday morning. So Lehman Brothers declares bankruptcy. Okay? And I know what it was like, and some of you back then, you're probably, yeah, well, so there's another one down the drain. Lehman Brothers declares bankruptcy. But let me give you a little example of how Wall Street works. Let's say today the Orlando Magic is going to play the Miami Heat in basketball. And you like the Orlando Magic, so you call up a bookie and you say, I want to bet $100 on the Orlando Magic against the Miami Heat. I call up the same bookie and I say, I want to bet $100 on the Miami Heat against the Orlando Magic. Well, now the bookie's got the best of both worlds because he's balanced off. He catches a little vig, which is his commission on the bets. Couldn't be better for him. Well, unfortunately for me, the Orlando Magic beats the Miami Heat. And you call up that bookie the next day and say, I want to make arrangements to pick up my $100. And you make arrangements to collect it from him. And then the bookie calls me and says, I got to collect that $100 from you for that bet you lost on the Heat. And I say, I don't have the $100, sorry. What do you mean? Well, I lost it. I mean, my dog ate it, or my wife won't let me pay it, whatever. Well, now the bookie's got a problem because he owes got to pay this guy the $100, but he doesn't have the $100 to pay him. Now, in terms of Wall Street, and you've probably heard these things before, you and me on two sides of that bet, we are what's called swap counterparties, okay? That's what a swap counterparty is, the two guys making the bets. Lehman Brothers was a $640 billion swap counterparty. And all of a sudden, they're tapioca, okay? They're out of the game. Well, what happens to the other side of the bet? Now Goldman Sachs is in trouble, now Merrill Lynch, now they're all in trouble because Lehman defaulted, all right? To make matters worse, here's how the game is played. The biggest insurance company at the time, by far, is AIG. I know you've all heard of AIG now. You probably hadn't heard of them. What AIG did for a living, where most of their revenue came from, they insured all of these bets that were made on Wall Street. So they're on the hook for $640 billion worth of bets just here between Lehman and Goldman Sachs and JP Morgan and them, all right? The government comes in now and takes over AIG, which in fact now, the government is now guaranteeing every bet that's been made on Wall Street, okay? Guaranteeing. Lehman Brothers bets, for lack of a better word, they're the swaps that they had made with other people, after they declared bankruptcy, were trading at 9 cents on the dollar, 9% of what they were worth. When the government came in and took over AIG, then the government, AIG, all one, is now paying back 100 cents on the dollar to everybody on Wall Street. This is what incensed everybody out there saying, wait a minute, you know, these guys created the problem and now they're making a profit on it. That's how the whole game was played, and that's how the whole thing came to a conclusion. Now, people may say, and I can tell you this, I've been in the business a long time. This is my 43rd year in the business. There's only been 2 times in my professional career when I thought it was going to be lights out. The first time was in October of 1987. October of 1987, on October, I think the 19th, the market dropped in one day 21 or 22% in one day, okay? That was the crash of 87. The next day, the market turned and went back up again. And there's a reason why that happened that I know so distinctly. But at any rate, had the market not done that the next day, I was with a company called Oppenheimer at the time, and the chairman of Oppenheimer and I were pretty close, and we were out having a couple of drinks about a month after the market crash. And he said that the next day, that Tuesday, after the market had dropped that 21%, if the market only would have dropped another 10% that day, he said Oppenheimer was gone, Merrill Lynch was gone, Payne Weber was gone, all the banks were gone, they were done, okay? And you say, why would that be? Because my wife said to me, why would that be? I mean, it's only down 20% or 30%. I mean, why? You have stocks that have dropped by that much. Wall Street operates on leverage, okay? Typically, Wall Street has maybe 3% invested in a deal and 97% borrowed, okay? If any of you ever had a margin account at a brokerage firm and the stocks went down, they call you up and say either you come up with more collateral or we're going to sell you out. Well, when you operate on 3% equity and 97% borrowed and the thing drops 21% like that, you are so far underwater that there's no way you're ever coming back, okay? We almost went down that time. This time with Lehman Brothers, in the third quarter of '08, most people didn't know it. People I talked to, they said, you know what, Lehman Brothers, screw them, they're greedy. And you know, people didn't understand. We were this close, and I cannot tell you how close to where we were going down. I'm talking about major, major depression. We were this close. It was really questionable whether we were going to pull this out. Nobody knew where these subprime securities were. They didn't even know where they were. They wouldn't know what was in it. I don't even know if they know today. They packaged this stuff together so much and just sold it to so many people in so many different places. This is what happened. Okay? As it turned out, the thing did turn, and I would say right now we have almost a 0% chance that there could be a depression or anything like that. It's never a zero, but it's as close to that. I mean, the thing has turned, but it was so close. And I remember going home telling my wife, I said, people don't understand what's going on. I mean, they're going to wake up tomorrow and there's not going to be any banks. Money's not going to be worth anything. I mean, the whole thing, it's gone. But fortunately, it turned and we are where we are today. Okay, if we may, I'm not real good on working these things. I want to go again to a real example of something that happened to me. In the early 1970s, a friend of mine that was a real estate attorney called me up and he said he wanted me to go look at a project that he was representing. It was called Shaker Village in Fort Lauderdale. It was a condominium townhouse project. So I went over to look at the project and I walked through the model and talked to all the salespeople, and I discovered right there that if I put down $3,000, I would have the right to buy one of those townhouses for $60,000 when they were complete. Well, $3,000 for me was a lot of money, and I thought about it for about a week, but I trusted my friend, and he told me it was going to be a nice project. So I went over about a week later, and I gave him $3,000, and I signed all the papers. Well, it took him about 2 years to complete Shaker Village. But when it was completed, I went over there, and I discovered that they were now selling for $70,000. Well, I had a piece of paper there that I paid $3,000 for that said I could have one for $60,000. That piece of paper was worth 10 grand, okay? Now I got two choices. I can either take that piece of paper over to the savings and loan and get a mortgage for $60,000 and go in and move in this place, or I can sell that piece of paper to somebody else and let them do it, which is what I did. It was probably the biggest hit I ever made. I tripled my money. But that piece of paper that I signed that day was a real estate option, okay? It was a real estate option. But what else was that piece of paper? It was a derivative, because it derived its value from the price of those condominiums. Derivatives are investments that derive their value from something else. If you buy a call option on IBM stock, it gives you the right to buy 100 shares of IBM stock at a certain price for a fixed period of time. That's a call option. That's a derivative. It goes up and down in value with what IBM stock does. If you buy a put option on Apple Computer stock, it gives you the right to sell 100 shares of Apple Computer stock at a fixed price for a fixed period of time. That is a derivative. It goes up and down in value with Apple Computer stock. If you're like Southwest Airlines, what does Southwest Airlines do with their money? They go out into the futures markets for oil, and they buy oil for April, May, June, July. Why? Because they want to protect themselves so they know how much it's going to cost them to fly their planes. Oil futures are derivatives. They derive their value from the price of oil. If you're a farmer and you're growing wheat or corn or soybeans, and you know your crop's going to be done and is going to be ready for harvest in May or June, what do? You go out into the futures market and you sell corn futures, locking in. Now you know how much you're going to get when your crop is ready for harvest. Those are derivatives. They derive their value from the price of corn or wheat. If you take a United States government bond, which all of you have seen and probably own today, you could take this happens every day in Wall Street. You take a United States government bond, say it's a 30-year bond. You take off all of the interest payments that are going to be due over the next 30 years. You put them together in a package. That's called an IO, interest only. Okay? Then you take the other half of the security, which is the principal, when it comes due in 30 years. You put that together in a package. That's called a zero coupon bond. Those two things that used to be a U.S. government bond are now two derivatives. They derive their value from interest rates and from duration, for time. But that's what derivatives are. And most people don't know what derivatives are, and most people think derivatives are bad. But I can tell you absolutely that almost all derivatives are good. Where derivatives got a bad rap was in the early 1990s, I think it was 1993 or 4, Orange County, California invested in derivative securities and they had to declare bankruptcy. And at the time, people were saying, derivatives bankrupted Orange County, California. Well, for those of you that were around then that knew that, let me tell you what happened with Orange County, California. Derivatives are investments that you can create, and we'll talk about some of the kinds that there are in a few minutes. But derivatives can be created for your need. Whatever it is you're looking for, they can create an investment. In the case of Orange County, California, why they did this, I don't know. But they created a derivative that borrowed money at short-term interest rates, which at the time were about 4%, and then took that borrowed money and invested in long-term U.S. government bonds, which at the time were yielding about 7%. Well, when you borrow money at 4% and you earn 7% on the borrowed money, you're making 3% on air. You know, you're getting 3% for nothing. They did this not for a period of days or weeks or months. They did this over a period of years, and it worked very well for them. And why did it work well for them? Because we were in a stable interest rate environment. Nothing much was happening. Okay? So it works good if everything remains the same. But in investing, believe me, nothing ever stays the same. It always changes. Okay? Well, what happened in the case of Orange County, California, in 1994, without ringing a bell, Treasury Secretary Greenspan and the Federal Reserve raised the discount rate 1/4 point. Caught everybody by surprise. You know, why are you raising interest rates? There's no inflation. Why are you doing this? President Clinton and all the senators and congressmen, you know, we can't have higher interest rates. That's going to hurt the economy. Well, it's an aberration. But what happened a short while there? Boom, they raised rates again by 1/4 point. Boom, they raised them again 1/4 point. Over a short period of time, they raised interest rates 3 or 4 times that nobody expected. Well, what does this mean to investing, going to the derivative of Orange County? Their short-term borrowings that were 4% now go to 4 1/4, and then they go to 4 1/2, then they go to 4 3/4, because every time the Fed raises the discount rate, it's passed along to the people that are borrowing, okay? So what happens to the things they invested in? Well, they start declining, because you know when interest rates go up, long-term securities decline. Well, even still, why would 3 or 4 raises cause something this serious to happen? Because they were leveraged 40 to 60 times on this investment, this derivative. 40 to 60 times leverage, which means they had virtually no equity. It was all borrowed money. So before you know it, what happened? Orange County, California declares bankruptcy, and they blame the derivatives. But in reality, the derivatives did exactly what they were supposed to do. I mean, that's how they were designed. They should just have never gotten involved in this. I don't know who the parties were that got involved, but my guess is the guy from Orange County, I hope there's nobody here from Orange County. Is there somebody that gets shot up here? But the guy from Orange County, my guess is, didn't really even know what he was invested in, or if he did, I don't know why he did it. And you know, I would think that the burden would fall on whoever sold it to him, and I don't know who did that either. But anyhow, that's derivatives. I lose track of time here, so I got to keep an eye on it and make sure I'm not going too long. One of the things I do want to point out to you, though, that's different now, I'm one of these old guys. You ever see the guy on TV? I want paper. I don't want computers. I want paper. Well, I'm one of those guys. I'm one of these old guys. But in the old days, if you looked on the floor of the stock exchange, there was millions of people down there. If I would have known any of you people in this room prior to 9/11, and you just called me up and say, hey, I'm going to New York with my husband or my wife or my kids, can you get me down the floor? I pick up the phone, I get your call, you'll be touring down the floor of the stock exchange. I couldn't get myself down there anymore. But the way it used to be on the floor of the stock exchange, there was people all over the place. Specialists, commission house brokers, traders, all over the place. They've all been replaced by computers. And if you watch CNBC on television, you see all the people there, that's because they're all running over to get in the picture. But if they took a thing and showed you the rest of the room, you'd see that there wasn't that many people there to begin with. But they replaced all those people with computers. Well, why this is not good is because when the market crashed in 1987, what turned the market that next day, that Tuesday? What turned it was all those people on the floor stepped up to the plate. They took, almost all of them, took all of their buying power and threw it in the market, and they turned the market. Those people aren't there anymore. Now if the market starts to drop, what they've done to make up for this with all this computerized stuff they've got, they stop trading. If the market drops a certain level, they stop trading. And then they wait, and then they'll open it up, and if it drops again, they'll stop trading again. That's the only thing we got. It's all computerized now. So when and if we ever do get to that point that we're going to have some major league sell-offs, it's going to be interesting to see what happens, because it is, without a doubt, we are a computerized market now. There's no question about it. What do we got talking about? All right, we'll talk about venture capital. Let's say, I'm just going to talk about some types of investments there are out there, and I'll give you some examples, and if any of you have any question. What I have found with Taft-Hartley funds in particular, there's not too much exposure to a venture capital, but I'll hit some of these anyhow. Let's say you want to start a business. You got a good idea, you got something you want to start a business. Where do you get the money? Well, there's only 4 places you can get the money, basically. First, you can use your own savings. That's one. Number 2, you can use what's called bootstrapping, which means you start out with as minimal amount as you can, and then you just plow it back in and you try to grow from the ground up. The third thing you could do is go out and get a bank loan, and good luck with that for any of you that are trying to get a bank loan. There's almost doesn't exist anymore. Or lastly, you can go to a venture capital company. Venture capital companies were very big during the dot-com era. That's where anybody came up with a good idea. They go to venture capital, they give them the money, they go public, their stock's going up 20 points a day, they don't have any business. I mean, it's just an idea. It was the dumbest thing I've ever seen in my life, but that's the way it worked back in the dot-com era. But if you're in the venture capital business, that's what you do. Most people don't invest their money in a venture capital deal. Most people will invest their money in a venture capital fund. Like a fund will have maybe $100 million, and they'll take that $100 million and they'll spread it out amongst 10 or 20 different investments. And when a venture capital loan is made, it's typically a 3 to 7 year loan. In other words, within 3 to 7 years, we want our money back. Either we're going to go public, or we're going to do we're going to sell you to somebody else, or something like that. That's how it works in the venture capital business. Typically, a venture capital investor or manager will demand that he gets between 10 and 50% of the stock in the company that he invests in. That's the way it used to be. I would guess in this market now, because bank loans are non-existent, they're probably asking for even a higher percentage to lend money for a venture capital deal. But that's basically venture capital, and unless somebody wants to talk more about them, or we'll do it at the end, but I want to get into a couple of other things that I think you do have more involvement with. And the first one is I want to talk about hedge funds. Now, I'm sure almost everybody in this room has exposure to hedge funds. And I would bet you that some of you people in this room don't have a clue what the hedge fund does or how they do it. That's really a delicate thing for trustees, because I know how some of these guys operate, and I don't know how it's even possible to follow what they do. But I'm going to give you some examples. First of all, the hedge fund business started by a guy named Alfred Jones in 1949. That first hedge fund that he started in 1949, over the next 20 years, went up 5,000%. So that was a good start for the hedge fund business. But typically, what's the difference between a hedge fund and an investment manager? The difference is an investment manager is competing against a benchmark. Like if you hire a large cap growth manager, he's competing against the S&P 500 index. So how many of you have been into a room when your manager comes in and he's all excited because the S&P dropped 10% this quarter and you only lost 7% of your money? And he's coming in to tell you how lucky you are that you lost 7% of your money. But that's the way they operate. But they're competing against a benchmark. Hedge funds don't compete against the benchmark. They're looking to make money, what's called absolute returns, no matter what. Now, there's only 2 ways you can make money in the stock market. There's only 2 things you can do. You can either buy a stock, hope it goes up in value sometime in the future, and you sell it at a higher price sometime in the future, that's called long only. Or you can sell a stock that you don't own, sell a stock short, hope it declines in value sometime in the future, and then you buy it in the future at a lower price. That's called short only. Most investment managers that you're dealing with, almost all of them are long only managers. All they do is buy stocks or buy bonds or something, but they don't short. Almost all hedge funds are long and short. Okay, they buy stock and they sell stock short. So hedge fund managers supposedly, or the way they advertise themselves, they should make money no matter whether markets go up or down. Doesn't make any difference. And over a period of years, I'm talking about many, many years, hedge funds are looking to make about 10% per year. 10% per year. Now, if you look in 2008 when the market was crashing, some hedge funds were down 70, 80%. And then the following year, 2009, when the markets turned, they're up 120 or 150%. But I'm talking about over a long period of time, hedge funds are looking to make about 10% per year. Now, hedge funds, not only do they go short, but they use derivatives. They use options. They use futures. They use anything they can to try to generate better returns. Okay? Now, up until recently, I think this has been changed with the Dodd-Frank law that was passed in July, but hedge funds weren't regulated by the Securities and Exchange Commission. I think, and I'm not positive, I shouldn't be saying this, but I think that they are regulated, except if they have like only less than 15 investors or something. But anything over that, I think they are regulated. The difference, though, the major difference between hedge funds and investment managers, one of the major differences is how you pay them. A typical hedge fund will charge a 2% per year management fee plus 20% of the profits that they generate for you. So imagine you give a hedge fund $1 million, and this year he's up 20%, $200,000. Out of that $200,000, you got to give him $20,000 management fee, plus you got to give him 20% of the $200,000 in a performance fee, which is $40,000. So you're giving him $60,000 now out of the $200,000 you made, so your 20% return just dropped down to 14%. That's how they operate. Now, the performance fee, the 20% of the profits, let's say the second year they go down in value, you don't pay them a percentage of the profits until they reach a high water mark. They go back above where they've already charged you for what they've done. There's a lot of different kinds of hedge funds. The best one I've ever seen out there, I don't even know how he works. I mean, honest to God, I don't know how anybody could follow this guy. But a guy named Jim Simons that runs a thing called the Renaissance Fund, okay? Here's how he charges, and here's how they've performed. And I have nothing to do with him, in full disclosure. I've never met him. I don't get anything for mentioning his name. He charges a 6% per year management fee plus 36% of the profits he generates for his investors. That's what he charges. What he does, his game, and I don't even know how he does it, but he's a mathematician. He trades every market in the world in a little black box, okay? And what he's trading, like if a stock goes from $2 or $22 to $22.05, back to $22.02, back up to $22.06. Most people don't even notice anything happen. He's just made like 100 trades in that stock. He's in and out, he's in and out. After his management fee and after his 36% of the profits, he's averaged 35% per year for the investors since the 80s. Okay? And I mean, he's been phenomenal. I see him on TV all the time. But I'm saying, if I'm a trustee or if I'm the guy that's supposed to be auditing this, I mean, how do you do that? I mean, I don't even understand what he's doing, but that's what he does. But anyhow, some of the more standard hedge funds there are out there, some of the more common ones, are what's called relative value funds, or arbitrage. Here's an example. There's zillions of these guys out there. The S&P 500 contract that's traded on the futures exchange, okay, that's a futures contract, a commodity contract. That is convertible into the 500 Standard & Poor 500 stocks, okay? What these hedge funds do, and it's all done by computer, they will buy the S&P 500 contract, they will simultaneously sell short all 500 stocks that are in that contract, and then they'll go back and forth. They'll buy short, back, forth, zipping them in and out. Every time they're just generating these little profits. That's what they do. It's all done by computers, and people wonder why the market's going like this all the time. We're in a computerized market now. I mean, it's like a big crap game run by computers, but that's what it is, and that's how a lot of these hedge funds operate. I'll give you another way that I used to do with myself personally. You could do yourself how hedge funds operate. There's a stock rating service out there called Value Line. Okay? Value Line rates stocks number 1, the highest, all the way down to number 5, the lowest. And they're very good. They've been around for many, many years. What some hedge funds do, and I used to do it myself when I was trading for my own account, you buy all the number 1 rated Value Line stocks, and with an equal amount of money, the same amount that you put in the buy side, you sell short all of the number 5 rated Value Line stocks. And the theory behind this is if the market goes up, the number 1 stocks will go up more than the number 5 stocks that you sold short. So you'll make a profit that way. If the market declines, the number 1 rated stocks won't drop as much as the number 5 rated stocks. And over a period of time, statistically that's the case with Value Line. Now, I'm not saying you wouldn't hit pockets of times when you'd lose money both ways, but I'm talking about over a period of time. That's how some hedge funds operate, doing that too. Keep looking at my clock here. Okay, I got to get going. A couple of other examples. Event-driven strategies, okay? Stock ABC closed Friday at $10 a share on the New York Stock Exchange. Over the weekend, somebody announces they want to buy all the stock of ABC. They want to pay $20 a share for it. Well, what happens on Monday morning? ABC opens up at $17 a share. Why didn't it open at $20, where their bid is going to be? There's questions whether the government antitrust people get involved and they don't allow them to buy it out. There's questions they won't be able to get the money to pay for it. For whatever reason, it opens at 17. Well, who's selling it at 17? All the guys that bought it on Friday for 10 and 9 the day before, okay? They're getting out. But who's buying it at 17? The hedge fund people are buying it because they've done their work over the weekend and they say there's a 90% chance the deal goes through. So they buy it at 17 and they're going to hold on until the deal goes through at 20. That's an arbitrage fund. There are market neutral strategies. Market neutral means you're in the same stock, basically. One's better than the other. You buy Home Depot, you sell short Lowe's. You buy Walmart, you sell short Target. There's a lot of hedge funds that do that kind. There's short-only managers where they do nothing but sell stocks short that they think are overvalued. There are distressed hedge fund managers who, back in 08, you could buy Citigroup for $1. You could buy Bank of America for $4. General Electric at $6. Who was buying it back then when everybody was panicking? The distressed hedge fund managers were buying. That's people that do that. And then you can do as my friend Bernie Madoff did, and that's you can buy stocks and sell options against the stocks. I got to tell you, I know we're running out of time, but I got to tell you this story because every time I think of Bernie Madoff, I think of something that happened to me. This is a true story. When I was in college, I took ROTC, okay? So when I graduated, my timing was perfect, just like when I buy stocks. I get out and I get commissioned in the Army right in the middle of the Vietnam War. But anyhow, I did it, and I get commissioned a second lieutenant in 1966, okay? So for a good portion of the time I'm on active duty, I'm stationed at Incheon, Korea, with the 202nd Transportation Battalion. And for those of you that have never been in the military operates like, whether you're overseas or in the United States, it operates like a business. I mean, they open up at 7 o'clock in the morning, and at 5 or 6 o'clock in the afternoon, they close it down, and everybody goes home, But in reality, especially if you're in an overseas base, somebody has to be on duty 24 hours a day, okay? Well, they always stick the young officers with that duty, and they're called staff duty officers. So once or twice a month in Incheon, Korea, I'm staff duty officer because I'm a young first lieutenant. Also, every night, there has to be a staff duty non-commissioned officer. So there's a staff duty officer and a staff duty non-commissioned officer from 6 o'clock at night until 0700 the next morning. So anyhow, I'm staff duty officer this one night, and I go around and do all the jobs I'm supposed to do, and I go down to battalion headquarters. The staff duty non-commissioned officer had to sleep at battalion headquarters on a cot. I was allowed to go back up to my what was called hooch, where I slept in a little bed where I had a potbelly stove, and there was a phone in my room. So I stopped down to battalion headquarters, and I saw the staff duty non-commissioned officer, and I said, all right, I'm going up to my hooch. Give me a call if anything happens. About 1 or 2 o'clock in the morning, my phone rings. It's the staff duty NCO. He goes, Lieutenant Noonan. He said, I'm sorry to bother you, but he said, I just got a Twix here from 8th Army. And for those of you that aren't old enough to know what a Twix is, it was the predecessor to a fax. Came over a machine, came in like that, but it was like a fax machine. He said, I got a Twix here from 8th Army that said there's been some guerrilla activity around the Blue House. I said, what's the Blue House? And he goes, I don't know. And I said, well, did anybody get hurt or killed? He says, I don't know, that's all it says. And I said, well, if I wake up the old man for that, I said, he'll chew me out from here till Saturday. So I said, just call me if anything else happens, right? So I go back to bed, and 5 or 5:30, I get up and I get ready. I go down to battalion headquarters, I sign out where it's 0700 and I'm gone. I go to work down to the port where I'm stationed. About 7:30 or 8 o'clock in the morning, I get a call from the sergeant major, and he goes, Lieutenant Noonan, and I said, the old man wants to see you. The port where I worked was about 20 or 25-minute drive from battalion headquarters. So I said to him, can I come by at lunchtime? I'm going to come into the base to have lunch. He goes, he wants to see you right now. I don't know, great. So I get in my Jeep and I drive over to battalion headquarters, and I walk in the door. The sergeant major waves me in. He said, he's waiting for you. So I walk inside. Lieutenant Noonan, sir. Lieutenant Noonan, were you staff duty officer last night? Yes, sir, I was. Anything happen? I said, there was just we got a Twix that said there was some guerrilla activity around the Blue House, but that's all it said, nothing else. And he goes, Lieutenant Noonan, do you know what the Blue House is? I said, no, sir, I don't. And he goes, let me ask you this. Do you know what the White House is in the United States? And I went, uh-oh. And he goes, Lieutenant Noonan, last night, North Korean commandos came in and tried to assassinate the president of South Korea 20 miles from where I was sleeping, and you didn't have the common sense to call me? He starts screaming at me. Well, right then I started to decide, I don't think I ought to make the military a career. I think I better look for something else. But I let him sit there and shoo me out from, and screaming at me. You could hear him 3 buildings away. So finally, anyhow, he threw me out of his office, and I went back to work. And anyhow, about 2 or 3 months later, the old man rotated. And for those of you that haven't been in the military, no matter where you are, there's always new people coming in. So when the new ones are there, there's experienced ones. They rotate you at different times. Anyhow, he rotated to wherever he was going next. And about 2 or 3 months after he left, I rotated. It was my turn to go. And so I was going around saying goodbye to everybody. And when I went into battalion headquarters, the sergeant major was still there. And he goes, so I understand you're getting out of the Army, Lieutenant. And I said, yeah, I'm going back to graduate school. And he said, well, since you're getting out, he says, I want to tell you a story. He said, you remember the day the old man shooed you out? And I said, I'll never forget that one as long as I live. And he goes, well, you know what happened that day? He said, he walked in here that morning, and he went over and he read the report that you filled out from the night before. And you know what he said to me? And I said, what? He said, what's the Blue House? This is a true story, I swear. But anyhow, it always reminds me of Bernie Madoff, because what Bernie Madoff did, this is unbelievable to me what this guy did. I mean, where I said at the beginning about common sense, there has to be common sense. Bernie Madoff, what he said he did, I never heard of the guy until this all happened. He bought stocks and he sold options against those stocks, listed options. You all see him trade on the market. His claim over a 20-year period, or whatever he was in business, he only had 2 months during that whole 20-year period that he ever lost money. Now, I can tell you categorically, if you come to me right now and you tell me you've got an investment manager that only had 2 down months over the last 20 years, and his style is he buys stocks and he writes options, I'll tell you he's a thief. I mean, there's no question about it. I mean, how this guy got away with this is it's just unbelievable to me. But it was unbelievable to me that Rico got a $450,000 mortgage, too, on his $2.99 bacon and eggs tips. But, I mean, some things that happen in business are so incredibly common sense. And that's why I always try to encourage people to just use common sense. There's big ads in the Fort Lauderdale paper where I live right now, 11% guaranteed. I showed my wife over the weekend. Well, here's another scam. 11% guaranteed. Tell me, what are they doing with the money? Now, that's not to say that Jim Simons can't make 35% per year in Renaissance, but he's not guaranteeing that. Okay? When somebody guarantees you that they're going to make a certain percentage and it's more than you can get in a treasury bond right now, I'm telling you that you better be careful, because there's something crooked going on. All right, we got a couple other things to talk about here, and I covered all those, I think. Those are the different kinds of hedge funds. I think we covered them all. All right, private equity. I'm going to talk about a couple of other things here, and then I want to open it up to questions for you. Private equity was started by the Rockefeller family right after World War II. And it was started with a company that eventually became Digital Equipment, which I think got bought out by IBM about 20 years ago. But the private equity was established to try to give veterans coming back from World War II a job. Basically, that's why they started the first private equity company. And it became dominated by the rich families, like the Rockefellers. But companies that came out and started as private equity investments were FedEx, Apple Computer, Cisco, Microsoft, Avis, Dr. Pepper. And basically, in saying private equity is the same as in venture capital I talked about earlier, most people don't invest in a private equity deal. They invest in a private equity fund that splits the money out amongst a bunch of different kinds of investments. Typically, private equity investments, they won't take less than $1 million in a private equity deal because private equity is probably the least liquid of any kind of investment there is out there. In the hedge fund business, back when the market started to crash in '08, a lot of hedge funds shut the doors and said, you can't get out now if you want to. Private equity, you hardly ever can get out anyhow because you're committing to invest so much money over a period of time. And it could be as long as 12 years. So it's definitely for people that want to stay in for a long period of time. Private equity, it's not unusual. Well, I shouldn't say it's not unusual. It has happened several times in the past where people lose 100% of their money. And it has happened more times than that people average 30% per year on their investments, as long as they've got that kind of money that they can tie up for that period of time. Typically, a private equity manager will invest between 1% and 5% of his own money in every deal. That's called skin in the game. The private equity market is nowhere near the hedge fund market is now approaching $2 trillion. The private equity market is now probably 15% of that. I mean, it's much, much smaller market. And I'm scooting along here because I want to leave time for you guys. I know everybody wants to stay here till probably 5 or 5:30, but I'm going to try to get us out here at least by 5:10, if that's all right. Is everybody all right with that one? Yeah, okay. Anyhow, one thing I do want to say, though, that I want to put in for not just for this session, but for every session, the way the International Foundation selects people to come and speak with them is by how they're evaluated on these sheets, and if they can keep you from dozing off in your seat in the back of the room. There was a number of years where we had to install seat belts in some of these rooms because people were getting the bruises on their heads when they hit the table. But seriously, I've seen where a lot of people go to these meetings and they give everybody 7s and 8s, everybody. It doesn't make any difference. And you're not doing yourself any favors if you like some people better than other people. But for sessions that you do like the people, please rate them accordingly. And for sessions you don't, please give them the low ratings accordingly so the speaker quality that you get in the future will be good. Fund of funds is something that, if I can I try not to put in my own opinion, but I don't like these things for a number of reasons, but some of you are probably in them. The reason I don't like a fund of funds, because a fund of fund is basically a fund that buys other funds and puts them all together in a package. So imagine you're going to be a fund of funds of hedge funds, for an example, okay? You're going to go out and buy a whole bunch of hedge funds and put them in your fund, okay? Well, now you're charging a fee for doing that. Each one of the funds that you've got in the fund is charging a fee. They're all charging a percentage of the profits. I mean, the fees are huge in funds of funds. And a lot of people say they do it for diversity. But let's say you're going to go out and buy a fund of funds of large cap managers, okay? You might have 10 or 15 different large cap managers' names in there, but they all own General Electric and Microsoft and Procter & Gamble, so you really haven't diversified there either. So, but that's what fund of funds are, and for those of you that have an interest in them, I shouldn't be saying that I don't like them because, anyhow, the last type of investment I want to talk about real quick is something that most of you don't know anything about. For whatever reason, the only people that I've seen that are investable people, pension fund people that don't invest in these are Taft-Hartley funds. And I don't know why. I don't know if it's because of the consultants or what. But structured products are investments that are created specifically for a fund. Like you say, I want a 5-year investment. I want an investment that pays 3% return. I want an investment that I can get out with no penalties every quarter. Whatever it is that you want, they structure it for you. The most common one, and I used to speak about these at the annual. I remember the first time I did this in 1995 in Honolulu. Right then, you could buy a structured product, and here's what it did. It's a 5-year investment, okay? It would go up 116% of whatever the Standard & Poor did during that 5 years. Standard & Poor went up 100%, you'd go up 116% on the upside. You had to hold it for 5 years. In the event the Standard & Poor declined in that period of time, you were guaranteed that you would never get back less than your original investment, guaranteed by the United States government. And people would say to me, well, how's that possible? I'll tell you how it's possible. It's real simple. Back then, you could do it. Today, the numbers don't work out because interest rates are so low. But back then, you could buy a zero-coupon government bond, 5-year bond, for like 70 cents on the dollar. So you take 70% of the money you're going to invest, you buy a 5-year U.S. government bond. That guarantees you in 5 years you got your money back, okay? The other 30%, you buy options, 5-year options on the S&P or whatever it is that you wanted to be indexed to. For whatever reason, nobody wanted to do that. You can't do it on your own. It has to be structured by an investment bank because there are no 5-year tradable options on the S&P or anything else. Anyhow, I could give you a lot of other examples of this type of product, but I've talked for an hour, and I'd like to leave it open for, please fill out those evaluation sheets correctly, properly, however, for every session. If you don't like people, write a little note on there that you didn't like. If you do, please write a note on there. And with that, I'd like to say I'll open it up to any questions that anybody may have.
Before we go to questions, I've got two here. Let's give Tom a round of applause.
Thank you.
If I may, let me lead off with these two questions. First one, could simple banking fundamentals have prevented the 2008 collapse?
That's the question?
That's the question.
Well, in this market, there's a thing, what happened was, and I was very much against this when they did it, about 10 or 15 years ago, what was the name of it? I get older, I lose track of what the name, it was called, the two names they used was like Smoot something or whatever, I can't remember. But there was a federal regulation that said if you were in the banking business, you couldn't be in the investment business. And they kept them separated, which I think is the way they should have left it. But they didn't. They let them go together. So when this crash came in in 2008, could it have been prevented? If the feds got involved earlier, if they would have marked to the market, if they would have made stricter requirements on people borrowing money. There was a lot of different ways it could have been stopped, but the way everybody was operating, no, I don't think it could have been prevented because it was just it was a wild, wild west. People could do whatever they wanted.
Second question, is there insider trading on Wall Street between the big boys, honestly?
Well, let me put it this way. I can't say that there is, but there is. I can't say here's who's doing it, but there's no doubt in my mind that there is. Yeah, the big players are. Wall Street, let me just say something real quick here for something that I want all of you people to think of in the future. And this is what I tried to get people to think of back, and without making a political statement, I want to say this, and I want to be very emphatic about this. If President Obama or President Bush or President Clinton or President Reagan or anybody else goes on television and says, well, we've got a problem and we want to do this. Okay, I'm going to sit there, I'm going to listen to them. Well, what's the problem? And you tell me, okay? This is just me. But when Hank Paulson, I don't know if any of you knew who Hank Paulson was. Hank Paulson was a big guy. This guy's a big guy. He's been around the block. You might not have liked the way he looked and you might not have liked the way he talked. But when he goes on television and looks in the camera and says, it's urgent, it's critical, we have to do this today, right now, we have to do this. When he says that, I'm listening, okay? And that's why I'm telling my friends back then, when they're saying, oh, what's the hurry, we don't have to do anything. I'm telling you, when somebody like Hank Paulson says this, it's the real deal, okay? And I can tell you now, Hank Paulson's gone right now, but there's two people out there that you might want to keep your eyes on, at least if you want to follow the way I think. I mean, I don't care what any politician says, and this isn't anything pro or anti any of them, but when they say stuff, I don't pay any attention to it. But there's a guy named Lloyd Blankfein, who's the head of Goldman Sachs. Or there's a guy named Jamie Dimon, who's the head of J.P. Morgan. If Jamie Dimon goes on television and he looks in the camera and says, it's urgent for the United States that we got to do this, I'm listening. And I would encourage all of you to listen. If somebody like that is saying it, these guys know the game, and they're there. I mean, when they say something's got to be done, and that's why I knew when Hank Paulson went on and it was so urgent that we had to do this immediately, I mean, he had me really scared because they don't do this unless they're. But if Jamie Dimon comes on and says this, it's the real deal. Anyhow, did I even answer the question? I forget what it was.
I think you did. You got one more question, and then we'll open it up to the
Okay.
floor. What's your view of real estate investment?
Oh, the other thing I want to tell you now, I meant to say that in the beginning of the thing. My opinion now, all right, and you know what I've always told people, I'll give you free advice, and if it doesn't work, you just bring it back and I'll give you some more advice, okay? But anyhow, one thing I can say though today, honestly, they're giving away real estate. They are giving it away. This is, in my opinion, this is a once-in-a-lifetime opportunity to make a lot of money. If you're a young person and you've got the capital to be able to carry a place, you know, in Florida especially, they're giving stuff away. I bought my son, my youngest son, a 3-bedroom, 2-bath house with a swimming pool with a big backyard, had a $375,000 mortgage on it. I bought it from the bank for $85,000 in a nice neighborhood. The cheapest any house had sold, even in foreclosure, was $199,000. And I bought it for $80,000. His neighbors were mad at me because it lowered their valuation. But I'm telling you, they're giving stuff away, and it's really, in my opinion, a once-in-a-lifetime opportunity to buy. Consequently, I feel good about real estate investment trusts. Personally, I've been in the stock market my whole life. I owned a stock brokerage firm until 2 years ago. But if I got a new dollar to invest today and I got a choice between real estate and stocks, I'm putting it in real estate. But I think real estate is really cheap, and I think you're never going to get another opportunity in your lifetime like we've got right now to buy stuff. And there's a reason why. The guy that trained me in the business used to say, the markets always accommodate the least amount of people. And just think of how things are. When everybody was buying .coms, who was the least amount of people then? The ones that were selling. Those are the ones the market accommodated. You know, in 05, 06, everybody's buying real estate. Who's the least amount of people? The guys that are selling. Those are the ones the market's accommodated. Who are the markets accommodating now? Everybody's throwing away real estate, right? Who's the least amount of people? It's the guys that are stepping up to the plate to buy. I mean, they're giving it away. They're not going to make any more. And I'm not in the real estate business. I'm just telling you, it's just from an outsider looking in, I think this is a great opportunity.
Let's open it up to the floor. Sir?
Yes, sir.
Do you think hedge funds have a part in your asset allocation?
The question is, do I think hedge funds have should be part of the asset allocation for a pension fund? And the answer is absolutely 100% yes, I do. The question now, which one do you want to be in? And the problem is some of these are very difficult to monitor what they're doing. And but you know, I definitely think they should be there. And more and more people are asset allocating more and more of their money to alternative investments too. And I think they should. Anybody else got anything? Or?
There's one right over here. Tom.
The question is, would I avoid fund-to-fund hedge funds as opposed to just buying one hedge fund? And the answer is, personally, just for myself, yes. I would invest in the hedge fund. What I usually do, though, is I don't invest in anything unless I check the people out. So I wouldn't invest in a new hedge fund, but I'd invest with other ones, and I'd ask for representative clients, and I'd call the people up, and I'd ask them questions and try to get a feel before I did it. But I just think the fees in the hedge fund business are so high that if you get involved in a fund-to-fund, you know, it's pretty hard to make money. But it's hard to say without knowing exactly which one you were getting into. But that's my own personal opinion. I don't really like fund-to-funds that much. Anybody else? Yes, sir. Yeah.
Funds that had exposure to Madoff that were subject to drawback.
Right.
Any experience on multi-employer funds being clawed back?
The question is, people that invested with Bernie Madoff, they have a clawback provision where there's a trustee that's going back to people to get the money back that they weren't entitled to in the first place. Have I seen it happen with any employer funds? I haven't seen it happen, but in my opinion, it's unquestionably it will happen, and they will get the money back. There's no question. I've seen this. We've got a guy in Fort Lauderdale who's now in jail for 50 years. He was an attorney by the name of Rothstein. What Rothstein sold was he went out, offered people 40% returns. He said he had these legal settlements where somebody sued somebody else, and if they got the money early, you could discount the people that had the money coming as opposed to waiting until you went through the whole legal thing. And he said you could get 40% returns if you held to the end. He raised $1.2 billion, never invested a dime of it, okay? But he was promising people 40% per year returns. And, you know, if you fall for that, you deserve to lose your money. And I don't care who tells you that. But anyhow, if you are invested with a Madoff fund, they will get your money back, yes. They're getting all the Rothsteins back from everybody in Fort Lauderdale. Yes, sir. In my opinion, sir? I can't hear you. In 2 years, where's the stock market? I think it'll probably still be in New York. No, I'm just kidding, because I'm probably the worst. I mean, you follow me. When I buy is when they go right down, and when I sell, they go up. But historically, I can tell you, historically, the market goes up 2 days for every 1 day it goes down. So I would always say, looking down the road, 2 years, 3 years, 5 years, it will be higher. Business is getting better right now. Believe me, it is. Business is getting better. And for people out there that are, for political reasons, they're saying this, that, and it is getting better. I know. I talk to people all over the country. Business is picking up. Look at restaurants. Look at stuff. I just heard on the radio yesterday on CNBC that for the first time since 2008, people have increased their credit card purchases by 2.5 or 3.5%. So, you know, as business gets better, the stock market usually gets better. So I would think that, you know, 2 years from now it will be better. And I didn't mean to be a smart aleck, sir. I didn't mean that. I was just trying to be. Anyhow, anybody else have? Yes, sir.
Why haven't the banks started to loosen up to lend more money?
Good question. Why aren't the banks loosening up to lend money? Perfect example. The banks borrow money from the Fed for free, which they do, and then they turn around and lend it back to the Fed and get 2 or 3%. That's what they do. That's what's going on in the market. The Fed gives the banks free money, they lend it back to the Fed, and that's what's going on in this great banking system we have. So until they stop doing that nonsense, they're never going to do it because there's no risk. They can, you know, that's the kind of return they can make. It's impossible to get a bank loan, basically, unless you're a big shot. Anybody else?
We're outside Buffalo.
Batavia. I went to Batavia High School. Are you from there?
We're from Buffalo.
Oh, you're from Buffalo? Yeah. My brother's still a judge up in Batavia. Yeah. Anyhow, listen, I want to thank all of you guys for coming. Have a great time in Orlando.
Thank you.